Hey everyone, my name's Andy. My channel's Finding Value. I was reading through the comment section and someone commented, I commented on commodities being a good hedge against inflation. And they made a comment about hyperinflation. And hyperinflation does have a different dynamic than just regular inflation. Regular inflation, what I mean by regular, is under 50% per year. So we'll go into what a definition of a hyperinflation is. And in a hyperinflation, things are going to be different than a regular kind of medium to high rate of inflation, which I'm saying would be between 5 and 10%. That's what I'm expecting. That's where energy sectors do incredibly well, and gold and silver, they don't do well as the energy sectors in a mild to high inflation rate. Hyperinflation, that's a whole different story. So let's look at the hyperinflation scenario to see where you'd want to be invested and how assets would perform in a hyperinflation scenario. So I'm going to dive into that. I'm going to use Germany and as an example, and a little bit of Zimbabwe. So what is hyperinflation? Hyperinflation is a term to describe rapid, excessive, and out of control general price increases in an economy. Really, hyperinflation is just the increase of the money supply on top of I'll get into it later, but it's a large increase in money supply. While inflation is a measure of the pace of rising prices for goods and services, hyperinflation is rapidly rising inflation, typically measuring more than 50% per month. So most people think that they're going to be okay with equities and real estate when hyperinflation occurs. Everyone in cash and fixed income securities will get obliterated. Let's look at some strategies for if a hyperinflation were to occur in the United States. So the wage of fear here. Most experiments with currencies end in hyperinflation with unconstrained money printing. The current system is 43 years old. That's what we're in. And the money manipulators are backed into a corner where they are holding assets up and need to hold interest rates down to keep the system solvent. The market naturally wants to deflate the bubbles of assets, but the central bank won't let it happen. Money printing is the anti-deflation measure they are pursuing, and that's what's going on right now. So naturally, the market wants to deflate the bubbles and put everything back into a balance. But what they're doing is they're fighting it with a massive amount of money printing. Gold is a universal monetary asset. Its value is derived by the market and an eternal form of money. Inflation could cause businesses to go under in terms of a hyperinflation, and gold proved to be one of the best performing assets during this hyperinflation period. I'll get into it a little bit and go over what some of the returns are. But for gold and silver, gold went from 170 marks to 87 trillion marks, which is a 511 billion times increase. Silver, that return was a 45 billion times increase. So in a hyperinflation, gold performs better than silver, at least in that hyperinflation that happened in Weimar Germany. So Germany, in 1918 to 1923, in 1914, Germany left the gold standard. Paper marks were worthless by 1923. So it was a very swift and short period where they had a hyperinflation. German equities lost 70% of its purchasing power in gold terms. So they did not keep up in terms of purchasing power. So if you did a ratio, gold outperformed equities, and equities lost by 70% in purchasing power. 80% poorer if you measured stocks in the real price of goods and services. That's your commodities type stuff. Ones that have intrinsic value and were very valuable to people and their survival. Massive stock market volatility occurred during this time frame. And in 1919, stocks lost more than 70% in 1 year to gold, in just 1 year. Speculative bubble in stocks. So in 1920 to 1921, there was a speculative bubble occurred in stocks, and the stock market had outperformed gold. Everyone was playing the stock market. Then in 1922, things changed dramatically. The public shifted and everyone piled into gold and foreign currencies as people were afraid of their currency. In 1922, the stock market went up tenfold right after everyone piled into gold. They also piled into stocks, but they still lost 70% of their purchasing power against gold and wholesale items. So what happened is everyone wanted to get out of the mark. They just piled into everything just to maintain purchasing power. But stock market went up tenfold, still lost 70% of its value against gold. So Germany stocks. In 1923, stocks did well again after everyone was piling in and had a classic crack up boom or melt up. Everyone tried to get out of paper currency and rushed to buy anything. Stocks over this period were still suboptimal tool for wealth protection in relationship to precious metals. Real estate. Now this was a little bit surprising, is owning real estate proved disastrous for those who were landowners and rented properties out. Rents were regulated by law, and in rapid inflation of 22 and 23 could not be adjusted quickly enough. They became a zero-yielding asset while maintenance costs exploded. The value of houses fell considerably. Landlords had to sell homes because rents did not cover maintenance expenses and were forced to sell. That was surprising. The causes of hyperinflation, and these were from another kind of, I did a dive into the root cause of hyperinflation, and this is what I think the most likely cause of hyperinflation is. Hyperinflation has never been a consequence of monetary policy or politicians turning on the printing press just before an election. Rather, hyperinflation is a symptom of a state that has lost control of its tax base. However, by the end of the 1990s, Zimbabwe's economic progress came to a halt and the country's economy entered into a depression. What caused this turnaround? Media reports often simplistically imply that the printing of money was the cause of Zimbabwe's economic collapse. However, in reality, the economic collapse came first, and the mass printing of money came as a consequence of this. Tax revenues declined dramatically. Now, I want to read one thing one last time. It says, the economic collapse came first, then the mass printing of money came as a consequence. Tax revenues declined dramatically. I think we're actually in a similar scenario right now to that being described. We had an economic collapse, COVID. We have mass printing of money that came as a consequence of this. And then tax revenues declined dramatically. People are out of work. They had a crack-up boom in stocks first, and then everybody rushes to gold and silver. Very, very strong parallels to where we're at today. So while the hyperinflation was made possible by the printing of money, it is not the case that money printing always leads to higher hyperinflations. Rather, it was the printing of money to finance expenditure with no regard for the inflationary consequences, and the preceding collapse in the productive capacity of the economy, which pushed Zimbabwe into hyperinflation. Wait. This is crazy, guys. Printing of money to finance expenditure, renewable energy, and the infrastructure. At the same time, preceding collapse of the productive capacity of the economy. We have that as well. That is interesting. It's drawing very good parallels to today. Had Zimbabwe's central bank been independent of politicians and focused on price stability rather than facilitating government spending, with more careful control over money creation, the hyperinflation would have been impossible. So they had reckless spending. They lost their tax base because of the productive capacity of the economy. Very, very similar to what we have today. So again, more hyperinflation causes. Hyperinflation in Germany and Zimbabwe was preceded by a fundamental collapse in the productive capacity of the economy, which started the inflationary pressure. In both cases, the economy collapsed and the government could not mobilize resources via taxation to fund expenditure. As was the case in Zimbabwe, desperate for funds, the government resorted to financing their spending through money creation. Hyperinflation was thus not a consequence of monetary policy, but a symptom of a state that has lost control of its tax base. So the conclusion here, the hyperinflation in Germany, real estate as a rental did abysmal. The stock market did horrible and lost 70% of its purchasing power. Boring old gold bars were the best bet during this type of environment. Things may unfold much differently than Germany's hyperinflation in the future for the United States. That's just one thing I wanted to make a comment. So, what I want everyone to get out of this is the sequence of things that happened here. The first sequence is they went off a gold standard. And remember, things could be compressed and ours could be drawn out. But it's the sequence that matters. They went off the gold standard. Their productive base, tax base, had problems. They had a collapse in the economy. They resorted to money printing. And the last kind of final straw was they resorted to money printing to finance government expenditures, and they lost their tax base. What do we have today? We have more people that are out of work. We are financing our expenditures, renewable energy, all these other things, infrastructure projects, all these different types of projects. And if we lose the tax base, this could happen. That's the sequence that happens. And when you lose that tax base, it seems like you have a crack up boom in stocks first. What are we having today? Potential crack up boom. What happened next in Germany was that people shifted their focus from a crack up boom in stocks and started worrying about the currency. The currency is where you're going to have a problem next, and where people are going to perceive the problem and then run towards safety. The safety that they ran towards was number one was gold, and the other precious metals were behind it. So all of the precious metals were, we'll call it a safe area for a potential problem like this. So gold performed the best, the other precious metals behind it, and commodities performed pretty well, especially those that had intrinsic value to humans that were a need. So is this going to happen in the United States? I don't know. But these were the sequence, kind of the order that happened and the reasons behind it, the causes. So now that you guys have seen this presentation, you can identify if a hyperinflation is coming by looking at this kind of process steps and how they resolved it. So if you see the government resolving it through money printing to finance expenditures and to finance other debt, you may be in a and we see high inflation. You tie this all together, and hyperinflation could come some years down the road. So what I do is whenever something's cheap, I buy it. Silver's cheap, platinum's cheap, physical metals, you buy it and you hold on. And then you look to see what really smart people are doing, what the wealthy are doing. And if they're loading up on physical metals, I think it'd be a smart move to do the exact same thing. If you guys like this content, give me a thumbs up. Appreciate you guys listening. This is Finding Value.